Okay, welcome everyone. Good afternoon. Welcome to our webinar, UK Housing, Too Much Debt or Not Enough Houses, with our CEO and Chief Market Strategist, Chris Watling. I'll hand over to Chris in a second. As usual, we will have Q&A at the end after Chris has spoken. So if you could use the Q&A button at the bottom of your screen to write your question, and I will then put the questions to Chris. So on that note, I'm handing over to Chris.
Great, thanks, Nick, and lovely to see everyone on the call. A great topic, fascinating topic, critical, I think. UK housing, too much debt or not enough houses. Clearly, there is. Let's see if I can get this thing to work. Clearly, there is an. Here we go. Yeah, here's what I want to dig into today. I mean, there's no doubt it's a very controversial topic in the UK. A lot of what I say, I think, applies globally, particularly to Western developed economies. So I think there'll be a lot of read across. And as I say, it's a very controversial topic in terms of the way the media think, politicians think, our policies formed, the way the economy grows, its influence on consumption, etc., etc. It's a long old list. So what I wanted to think about, first of all, is just lay out the fact that housing's expensive. That won't take long. And then talk about what the consensus view is about what drives house prices. The idea that there's not enough houses out there. There's a lack of supply of actual physical homes. And then I want to make the case against looking at the international comparison, looking at a regional comparison, and then talking about really how the financial system has changed in the last 30 or 40 years. And what really, in my opinion, drives house prices, which is not the lack of supply of houses, but the massive supply of mortgage debt and money creation, which goes with that. And then talk about how the financial system has changed over the last 30, 40 years to allow that process to evolve. And then I've got a couple of quick suggestions on how to fix it. It's interesting to see what people make of that. And then we're going to get into the sort of nitty gritty. What is the outlook for house prices in the next sort of 3 to 9 months, the near term? And then get into one of my favorite topics, the 18-year land cycle, and the idea that we're going to move into the winner's curse phase, which has not only big implications for house prices and speculation in land, but also big implications, I think, for the UK stock market. And then we'll conclude. So let's dig in. So look, first off the bat, I mean, housing is clearly expensive. You can pick your poison in terms of your affordability or valuation ratio as to how you want to think about it. But on the right-hand side is a classic house price to income ratio going back to 1930. In fact, it gives you a good reminder of all the housing booms that we've had over the last 100 or so years. Post-World War II, late 1940s into early 1950. Then the Barber boom in the 70s, the Lawson boom at the end of the 80s, the noughties boom into the GFC, and then of course the fact that we're very, very expensive as we are at the moment. So we are just off record 100-year house price to income ratios in the UK, and you can make that point in many countries around the world. Or equally, from affordability point of view, things are looking quite expensive. This is a affordability ratio put together for a full-time worker on sort of mean earnings and all sorts of calculations that you can see below to make it standardized across time. So the black line is the average. It's moving up. It's not far off. It's peaks GFC, and it's not that far off. It's late 1980s, early 1990s peak. So housing is clearly expensive. Another way of looking at it is mortgage costs as a share of GDP here. We've included our forecasts out to 2025 with implied mortgage rates as implied in the market. So we've taken Bank of England consensus forecast rates from the market, added a spread to get to a mortgage rate, and then multiply that by the amount of mortgage debt and done some estimates about fixed versus floating shares going forwards. And you can see that the mortgage costs as a share of GDP tracking at the moment just shy of 4%, get all the way up to sort of 5.25%. Out to early 2025, and the sort of absolute pound number is on the right-hand side. So, housing's expensive. The cost of mortgages is going up a lot because of base rates going up and remortgaging and so on. And there's a big debate out there as to why. A very big debate that really goes back, I think, all the way to the Barker Review, if not further, but probably really to the Kate Barker Review. Kate Barker was a member of the Monetary Policy Committee in the late 90s, early noughties. If I remember correctly, it was when she came off that she was commissioned by the Treasury to do a review of housing. Why are house prices so high? Is it lack of supply, etc.? And, in 2004, she came up with a quote you can see at the top of this page, that it's really a series of policy recommendations she set out to address the lack of supply and the lack of responsiveness of supply of housing in the UK. So, you can basically trace all your way through chancellors since then. I've got Philip Hammond here in 2018, Sajid Javid, who was Secretary for Housing, but also Chancellor in 2023, actually a couple of years earlier. That was a quote in 2023, lifted then. But you can trace it through all the chancellors, Osborne, Gordon Brown, since the Barker Review, all taking the same point of view, that we don't have enough houses in the UK. We need to build more houses, and that is why we have a problem with house prices being too expensive. And of course, as you know, it's critical. It feeds into wealth inequality, the generational inequality, the amount of rent being sucked up by the sort of millennials and Gen Zs in terms of their income. Rental payments are sort of up at 30, 40, 45, 50% versus 15 or 20% if you go back 2 or 3 decades. So rental costs is sucking up a lot of purchasing power out of the sort of bottom half of the working age population, and they can't afford housings, they can't afford deposit. And in the views of the Centre for Policy Studies, this quote you see at the bottom here, they make a very strong case. They're convicted of the idea that Britain has a housing shortage, and it's not contentious. The fact is not contentious, or at least it shouldn't be. You can see their frustration coming out there that people would question that argument. So let's dig into what they're saying, because I think it's not as obvious as it seems to me. The argument you get from these guys is, well, look at the chart on the left-hand side. Clearly, we were building a ton more housing in the 70s and 80s and even 90s than there was growth in the population. And that's why house prices seem were much more sensibly priced if you go back into that time frame, 70s and 80s and so on. And since 2001, 2, we've had a huge boom in house prices leading up to the GFC, a correction in the GFC, and then a rally into the pandemic and so on. And their argument is, well, it's simply the fact that population growth, as you see in the bar charts on the left-hand side, in the noughties and the tens, have been about the same as the house building growth. And they go on to make the point that if you look at average dwelling sizes, it's not just not enough houses, we're making small ones. But I would say let's dig deeper into that detail, because it's not quite as simplistic as they make out. And I would suggest that if you start splitting that apart, you start getting a feel for what's really going on. And of course, what we really had post-World War II was a house building boom, because so many houses and housing stock had been damaged or destroyed in World War II. There was a massive need to catch up. And there was also the case that household sizes were shrinking dramatically post-World War II. So there's a lot of things going on that meant we needed a lot of new houses at that time, as I say, to replace the housing stock, or really as household sizes got smaller and household units became less across the generations, if you like, with the grandparents living separately from the parents and the kids and so on. So there was a lot of housing completions, absolutely, in the 50s, 60s and 70s. And then you can see the population on the right-hand side. But if you put the two against each other, you can see that there was way more than we needed in those earlier decades post-World War II. The amount of housing completions are considerably above the level of household formation. Now, what I've done here is, rather than look at population growth, I've looked at assumed average household sizes are the same throughout the last 50 years. That's not a perfect assumption, but it's good enough for this chart. I'll show you the progression of average household size in a second. But you can see quite clearly that the number of new housing completions, the net new housing stock growth, which is basically what that is higher than the net new household formation almost all the time, except for in 2007 to 2016, which we'll get into in a little bit of detail in a second. But in reality, the build-out has been plentiful, unless you believe household sizes should be considerably smaller. And I think what's interesting on that aspect is if you look at average household size over the last several decades, yes, it came down into the 1950s, into the 1960s, even into the 1970s. But this data from the annual census, the every decade census, the decadal census, shows you that since 1991, average household size has been unchanged. So either it's the case that people want to live in even smaller household sizes than 2.4 persons per household, or it's the case that we're building enough houses and something else is pushing up house prices other than the fact that there are not enough houses being supplied. So, this is really key. And I think it's interesting to me, people talk about the fact that there's a lot of 18 to 35-year-olds still living at home. And that is true. There's a lot more than there were as a share of that age group 30 or 40 years ago. That's absolutely correct. But I would argue that reflects the fact that affordability is a real issue. It's sort of chicken and egg, which goes first? Is it not enough houses? They become expensive and therefore they live at home? Or is it that their houses become expensive, therefore they can't afford to move out, whether it's to pay rent or to buy their own house, and that's why they live at home? And I would suggest it's the latter, and I hope to show you more information on that as we go on through. But let's just get a bit of perspective here, because in terms of population growth, yes, it's been felt like it's been very high in recent years, and there's been a lot of media noise about immigration, particularly when we were in Europe, and more recently with the big sort of 600,000 net immigration numbers in the last annual data point. So, but really, if you look in the perspective of population growth over 120, 130 years, as we're showing here, the numbers of late are, they're a bit high. But in percentage growth terms, they're not outrageous. They're within the range of the last 120 years. They're nothing special. And interestingly, if you look at the noughties decade up until 2000, and what are we showing there? 2003, or in the 90s up until 2003, and the 80s and 70s, you were below average. So, I think it's nip and tuck, it ebbs and flows. We've had about 10 years of above average, but not that much more. So I'm not convinced it's population growth that's making all the difference. I'm not convinced we're not building enough houses. I'll show you some more data again on that in a second. But the other argument you get is, well, okay, fair enough. Maybe household size is what it is, and it's reasonable and makes sense at 2.4. It doesn't need to be smaller, therefore there are enough houses in that respect. But what about the idea of second holiday homes? Has there been a boom in second holiday home buying? Or what about overseas buyers of homes? Are they the reason our house prices are expensive? Are they the marginal buyer that's pushing housing up dramatically over the last few decades, as the Chinese buy and the Middle East buy and everyone from across the globe comes to London to buy housing? Well, let's take a look at those 2 points. First of all, let's start on the left-hand side with the second homes point, because once again, the census data has fabulous insights into this. And once you dig into the census data, you can see that the number of second homes, and by second homes, I'm not talking about a home that's a buy-to-let, that's bought by a pensioner to let out for income. I'm talking, because that basically is lived in by someone. That's a rental versus buy argument. I'm talking about second holiday homes that are bought purely for Airbnb purposes, or just because someone wants a second home by the coast or wherever. And if you look at the number of second homes, holiday homes in that definition, they are basically unchanged in the last decade. The census in 2021 had the total in the UK at 447,000. The census 10 years earlier had it at 426,000. So really trivial 20,000 more homes that are second holiday homes in the last 10 years. So it's not that driving the equation. You know, at very, very margin, it makes a difference, but it's trivial. It's not important. So I don't think it's that. And then, you know, overseas home buying, much harder to get data on. We've dug some out here from Savills. It's a bit old, fair cop. But what Savills show is that really almost all the overseas buying of homes, it's expanded a bit in the last decade, but almost all of it is prime London. And prime London is only 8% of the total London market. So it's actually a small part of the London market, never mind the whole country market. And in fact, if you look at the main buyers of prime London, most of them are UK buyers. And then when you're looking at overseas buyers, it's often because they're buying as a main residence. They're coming to the UK. So they're part of the immigration stats. They're part of the population growth. And when you really boil it all the way down, the numbers become actually quite small in terms of overseas buyers. Yes, they get massive headline attention in the media, Chinese buying, Singapore buying, whole, you know, buyers of shows in Singapore, if you like, property shows, property conferences, exhibitions whereby they sell a block of flats in the Battersea power station, for example. That kind of stuff gets a lot of profile in the press, but the numbers suggest it's not really as big as you might imagine. It's not really the major factor at work. And the other thing I would say in terms of overseas buying is really we're sticking it in the wrong category. Because if it's overseas buying just as a sort of a place in London to park money, it's essentially speculation to do with money creation and to do what we're going to get onto in the second half of the presentation. So actually, it's not really part of that equation that there's not enough houses being built. It's more part of the equation. There's massive money creation, and there's been a massive debt super cycle over the last few decades as we've deregulated global finance, which, as I say, we'll get into. So I don't think it's about second homes. I don't think it's really in this pure sense of the term, pure sense of the argument about overseas buying. And actually, when you add it all together and you look at the surplus housing stock in the UK as a share of total housing stock, not as a standalone stat as well, but as a share of total housing stock, it's basically been going up pretty much most of the time for the last 3 decades. And you can see from this chart, if you wind back to the mid-1990s, surplus housing stock was about 3% of the outstanding stock, and it's now about 5.5%. In other words, what that stat is really showing you is that over the last few decades, the household formation has been growing slower than the growth in the housing stock in terms of net new supply. So it's not just housing completions. Of course, on top of that, you've got, you know, brown renovations doing up, expanding, and so on, and bringing in unused housing stock into the equation as well. So the surplus housing stock's been going up. So you add it all together, I think from a supply of houses point of view, the data's not compelling. Whether you may well make your comparison to Europe. They do build more houses per person in France and Germany. But again, that's not really the point. The point is we've had growth of housing stock faster than household formation growth. So let's dig into the pushback on that argument from other perspectives. Because if it was truly about Britain not building enough houses, and that was the reason that our house prices have gone up so much, then surely you should be able to do a correlation across countries, looking at growth rates of housing completions, growth of the housing stock versus cumulative house price growth. And that's what we've done. That's what we've laid out here. And it shows pretty clearly there's no correlation between those two factors. In fact, if you look at what we're showing you here on the y-axis is cumulative house price appreciation over 3 decades. What we're showing you on the x-axis is what I would call tightness of housing supply. So really, we're pitting 30-year growth in housing stock against 30-year population growth. So taking the average annual growth rate of both, one minus the other, and it shows you how tight population growth is relative to housing stock, tightness of that supply of new houses. And so, for example, if you look at the UK, we're just right of the zero line if you look at the x-axis, which means we've just kept ahead of population growth with the housing stock. If you look at Ireland, massively ahead. If you look at Australia, slightly left of zero. And then if you look at sort of Netherlands, Canada, New Zealand, the bulk of the countries are sort of in the 15 to 30% relative growth rate range over those 30 years. So my point here would be, however much housing stock has grown relative to population growth, in terms of Ireland, Netherlands, Canada, UK, and Australia, they've all had pretty much the same cumulative growth in house prices. In other words, the growth of housing stock, however, when they've built more houses or less, it hasn't made any difference to how much the house prices have gone up over 3 decades. It had no impact whatsoever. Equally, you could look at it on a sort of a vertical line from New Zealand down to Germany, whereby they built about the same amount of housing stock relative to population, but have massively different outcomes in terms of house prices. So really, you could have two sort of, it's like a sort of cross here, a sort of horizontal and a vertical straight line, showing you there's no correlation whatsoever really between these factors. You could just about scrape one out if you wanted to, and you excluded a couple of data points, but it's certainly not convincing if Australia can have the same amount of house price appreciation as Ireland, yet a completely different playbook in terms of build out of housing supply. So from an international point of view, I think the evidence is pretty clear. I think it's also pretty clear from a regional point of view. And let me show you a couple of examples. So we spent a number of years digging into the regional house price behavior across the UK and getting a good feel for that. And here you can see what I would call, these are basically the regional versions at 3 timeframes: 2001, 2011, 2021. And it's the housing, surplus housing stock by region. So, for example, at the top east, in the eastern region of the UK, surplus housing stock is just over 6%. So going back to that number I showed you just before, we're at 5.5% for the UK. The eastern part of the country is slightly above that. And you can see the evolution of that from 2001 to 2011 to 2021. In other words, surplus housing stock in the east is around 2 and a bit percent. It's now over 6%. And every region except for one, you see an improvement in the surplus housing stock data. In other words, it seems as though there's plenty of housing being built. Yet despite that, we still have charts like this, and we still have really expensive regional house prices. And I'll show you some of the house prices in a minute, but let me show you a few examples of that. And I've picked 1 or 2 random places. I've picked them outside the southeast of the UK, particularly outside London, but outside the broader southeast, so you can get a good sense of the breadth of what's happening in the country. And here's a place called Pendle. It's circled in red on the right-hand side. It's not on the coast. People don't buy second homes there. It's a pretty low-income neighborhood. It's not popular with overseas buyers. And in fact, the left-hand chart shows you that the cumulative population growth over 25 years is about 7%. The cumulative growth in the number of dwellings is about 6.5%. So not much in it, pretty similar along the way. And you can see the bottom blue line is the median income growth, which is relevant for what when I show you the house price chart in a second. But you can see, go back to 2000, median income growth about £18,000. Median income in 2000, 2001, latest data, it's about £24,000. So bear that in mind as we look at the house price chart. Here on the left-hand side is Pendle house prices. So as I said, this is a £24,000 median income town or borough. It's now got an average house price of £140,000. In other words, it's trading about 5.5 times median income. And if you go back to 99, 2000, you can see there the average house price was about £32,000. So house prices have gone up by a factor of, what is that, 4 and change, 4.5, coming on for 5 times over the course of the last 25 years. Median income has gone up from 17,000 to 24,000, which is, what is that, about a third? That's about 30% rather than, as opposed to 4 or 5 times. And of course, the house price to average income ratio has done what it's done. There's absolutely no chance for anyone in Pendle to buy any of the average houses if they're on the average income and they're not already on the housing ladder. So there's been massive growth in house prices in the northwest of England, which is where Pendle is. Let's flip around the country. I won't go into all the detail, but median incomes aren't that different from what I've just shown you in Pendle in all these places. Here's Gateshead. I throw it up there because my in-laws are from around there, so I know the area. It's not a particularly wealthy area. It's much better than it was 2 or 3 decades ago, but it certainly doesn't have incomes like you have in London. And the average house price there has gone from 90,000 to 245,000. So two and a half times. Lincoln on the right-hand side, same sort of example over in the eastern region of the country. So, housing's become deeply unaffordable across the country. This is not just a London thing to do with overseas buyers. This is not just a coastal thing to do with second home buyers, because there aren't that many of them anyway. And this is not to do with a lack of housing supply, because in all regions of the country, we show that surplus housing has gone up, except for one region where it's gone down. So, really, the reason we have thousands and millions of renters now up significantly is because house prices are so expensive. But as I say, let's dig into what's been driving them, because it's not, in my opinion, about the lack of housing being built. It's about the massive supply of mortgage debt. So I want to move into the theme that I call from a mortgage queue to an eighth. This, I think, is the real driver of house prices. And this should give us some good insights into how to fix this housing crisis, if only policymakers would get a hold of it and start implementing something sensible in terms of how to fix this economy and how to fix these house prices. So, what's it about? Well, the mortgage queue to an eighth is really about the last 40 years. And there are 3 things that have been going on that have driven this story. And really, you have to go back to the 1970s, which is when we used to have mortgage queues. Frankly, I don't remember them. I was alive, but I certainly wasn't queuing for a mortgage. But I've certainly talked to parents and grandparents who've relayed these stories that in the old days, in the 70s, at a building society, might be a credit union in other parts of the Western world, but you'd have to queue to get a mortgage. You'd have to wait till enough people had saved money. You'd have to wait. And of course, this is the origins of the original building society, is I think 17 or 18 people in a pub all agreeing to save, drawing straws as to who got the money first to build the house. And then as you pay back the mortgage and you move through the queue, everyone gets a house over time. So this was the 1970s. You'd go into the building society, you'd be seen as a good fellow, reputable, and you get in the queue and wait until people had saved enough money and you could take out your mortgage. Now, arguably, that's not an ideal scenario, but what it meant was there wasn't a massive growth in mortgage debt. It was a bit like a narrow banking system to a degree, not fully, but to a degree. And that, it's like a bit like economics 101 in your textbook. This is what they tell you at university. It's not true. But the idea in the 70s, which was the case then, it's not true now, sorry. In the 70s, you'd have to save and wait till someone had saved the money, and then you could borrow it. So in other words, it wasn't the case that money was created out of thin air. Now the important driver of this, factor number one, driver of this theme, is the idea that we've had an unanchored monetary system for the last 4 or 5 decades. Since we came off Bretton Woods in 1971, the international monetary system has had no anchor. And without an anchor, and by an anchor, I'm talking about gold, or I'm talking about the dollar being, under Bretton Woods, being linked to gold and everyone else being linked to the dollar. So everyone's anchored to something that has a finite supply. When there's a finite supply as an anchor, commercial banks can't just create money willy-nilly. In fact, they're restricted very much in how they do that. And you go back to the days when the current account balance really mattered. And as soon as it came out of line in the 60s and 70s, gold would flow abroad, the money supply would tighten up, the economy would slow, and the current account deficit would go back into balance, and so on. So, but for the last, since Bretton Woods, and in fact, if you read Paul Volcker's book, written just before he died a few years ago, he tells you it was almost an accident that the West never went back on a monetary standard. They came off, obviously, because Nixon wanted to take them off because there was too much pressure linked to funding the Vietnam War and so on. But actually, the intention was always to go back on, and that never happened. So we've had an unanchored monetary system that allows money creation. Point number one. Point number two is that really we've deregulated the financial sector since Margaret Thatcher. it was Margaret Thatcher that deregulated the building societies, allowed commercial banks to enter the mortgage market, and got the whole kickstart with deregulation of the financial sector in general. Now, some of that's good, some of that's not so good. And of course, what happened is we had Margaret Thatcher, then we had Basel 1, 2, and 3. And what they did was they introduced risk weightings on assets. And what's developed over the last sort of 2 or 3 decades is really risk weightings that have gone down to favor banks holding mortgage debt. In other words, if a bank wants to hold a corporate debt, its risk weighting is 100%. If they want to hold a mortgage debt, it's down at sort of 12, 13, 14%. As you can see in this table here, it's a little bit out of date, but the numbers aren't very different for risk weightings of mortgage debt in Barclays, Lloyds, HSBC, and so on. So this is why we talk about a mortgage queue to an eighth. You need about an eighth of the amount of capital. 12.5% is an eighth. You need about an eighth the amount of capital to hold a mortgage if you're a commercial bank in the UK than you do to hold a corporate loan. And that creates massive skewed incentives for commercial banks to make mortgage loans. Not only that, but of course the collateral is terrific. They've got their 5, 10, 15 or 20% haircut when someone pays a deposit. And then they've got the asset as backing to the debt. And they've also need much less capital to apply against it. So they can make a much higher return on capital by lending mortgage debt rather than lending out to corporates, which is a 100% risk weighting, so a much lower return on capital. So the skewed incentives encourage the commercial banks to make a massive amount of mortgage debt, to supply mortgage debt. And in fact, this is how you work out where housing market's going to go. What are commercial banks up to? What do they want to do? Do they want to push mortgage debt out the door? What are interest rates doing? And so on. And what that's done is it disincentivizes them from lending to other parts of the economy. And it's meant that if you look at something like Barclays loan book in the UK, and you look at 1980s Barclays Bank annual report, you would see that the mortgage debt was 0 in the loan book. Now, since then, they've acquired a few building societies. They also made a ton of mortgage loans. And now the mortgage debt in the UK commercial banking system is about 2/3 of the entire UK loan book by the commercial banks. So the commercial banking system has changed from being a server of corporates to a server of the housing market. And as I say, it can do it by creating money. They do not, Mervyn King himself, when a bank makes a loan, it creates new money. And this whole thing was aided and abetted by the fact that in the 1990s, the central banks in the UK and around the world moved from money supply targeting, which was their thing in the 80s, which didn't work very well because of the deregulation of finance, confused all the monetary metrics. So they weren't good read on CPI in the 80s. But they moved from money supply targeting to CPI targeting in the 90s, starting with the New Zealand Central Bank in the early 1990s, and throughout the 90s, moving across the Western world. In the UK, 1997, Gordon Brown reforms, we start targeting CPI. And as they target CPI, they de-emphasize the money supply metrics, which would pick up some of this rapid growth in mortgage lending. So it becomes irrelevant to the central bank. CPI is all about your model, your dynamic general stochastic equilibrium model, which is all about inflation expectations. It's nothing to do with money supply growth really at all, in fact. And so, the mortgage debt growth is allowed to happen in the background. Commercial banks create money, and that's why you have such massive growth in mortgage debt. And in fact, if you want to get a bit of perspective on this, here's 150 years of real house prices in the UK. You can see the evolution from, now, look, sure, you may well say, well, there wasn't much of a private housing market in the 1800s. True, but there was a land market, and land is the majority of the house price. So this isn't totally irrelevant. You can see in there the late post-World War II housing boom in terms of house prices. You can see the Barber boom. And then, of course, you can see what happened after that from 1980 onwards as we deregulated finance. And just backing that up, you can see in this chart on the left-hand side, the massive growth in mortgage debt from 10% of GDP in the 40s, 50s, 60s, and not much more in the 70s, then exploding up towards 80% of GDP by the end of the GFC. So I would argue that really the main driver of the last 40 or 50 years, particularly the last 20 or 30 years of house price appreciation, and the reason we've had such rapid growth in price appreciation, way over and above CPI, way over and above nominal GDP growth. The reason we've had that is the massive supply of mortgage debt, which is all down to the fact that we deregulated the financial system. We had an unanchored monetary system. Commercial banks could create new money, and they did that every time they made a mortgage loan. And they were massively incentivized to make mortgage loans over other loans because they could get much better returns on capital, much better returns on equity if they did that. And so that's why we've ended up where we are. It's the supply of mortgage debt, not the lack of supply of housing, that's created a massive housing boom in the last 3 or 4 generations. In fact, on top of that, it's massively undermined productivity growth. It's been really bad for our economic model in general. And it'd be wonderful if policymakers would wake up and start to see this and start to change the system and maybe even anchor the money supply. So how do we fix this problem? Well, if that's the problem, you fix it by restricting the ability of commercial banks to create money. Now, maybe you do that slowly, maybe you do that quickly. Of course, that's a political choice, and there are arguments for both. I mean, the argument for doing it slowly is you could slowly tweak the risk weightings on mortgage debt and move them over 30 years back to or towards 100%, such that they're very similar to what we see for corporate loans. And that would gently restrict the supply of mortgage debt. I would argue, since it's the supply of mortgage debt that's pushed house prices up, as you restrict it, you should see house prices come down. That would be a slow way to do it, perhaps more politically palatable, adjusting those risk weightings. A faster way that might be a better way, because you clean the system out quick, and you would get quicker back to stronger productivity growth, quicker back to a financial system that really has the role it should have. And that is really to adopt something akin to a narrow banking model, perhaps not going quite that far, but really sort of a form of monetary anchor that restricts the ability of commercial banks to create money off the bat. But of course, that's much quicker, that's more dramatic than the slow way, and therefore perhaps politically less palatable. Or maybe as an alternative solution, include house prices as part of the Bank of England's remit. But we've sort of tried to do that with prudential regulation. I don't think it's really cut the mustard. I don't think it's really made too much a difference. I don't think it's really solved the problem. So I would have thought that one or two of these, number one or number two, is the way to go about fixing this housing problem. So that's kind of the guts of the debate out there. And I'm going to move on to the near-term outlook for house prices in a sec. That's the guts of it. I think it's mortgage debt supply, not lack of supply of housing. And yeah, that's where we're at. So let's dig in. Let's just move on now to the outlook for housing in the near term. Let's say the next 3 to 9 months, and then I'll whiz that into the next 2 or 3 years, and we'll come in to conclude. So what do we think in the near term? Well, 3 points. Firstly, I would say the market is dead. Anyone that lives in the UK knows that, or anyone that follows this data. Extraordinary that if you look at net mortgage lending on the left-hand side, that the net capital lending is negative and has been for a couple of months. That happened briefly in the pandemic. You can see that data point there when the stamp duty holiday ended, which I think was in 2021, I forget, mid-2021, I think, June or July. After that ended, that of course you got a negative month because it all got front-loaded into the couple of months before that. In the pandemic in 2020, you almost got negative, but not quite, in April. And then in the GFC, you almost got negative. But incredible to see where we are. It's a dead market. People are repaying more capital in their mortgage every month than is being borrowed in new mortgages. And you get a feel for that with mortgage approvals on the right-hand side, which are really tracking at very low levels. So point number one, the market's dead at the moment. Point number two, it doesn't look like it's going to pick up in the very immediate future. Both of these indicators, are good sort of near-term 3 to 6 month indicators of where UK housing is about to go. And both are suggesting, whether you look at RICS on the left-hand side or you look at a credit conditions index on the right-hand side, both are suggesting near-term softness, weakness, continued weakness in UK housing over the next 3 to 6 months. But as I say, I think it's all about the flow of mortgage debt, and therefore it's all about the banks and what happens to interest rates. And on the banks, I would say it's interesting. If you look at the banking system, they look pretty keen to lend money. You know, you listen to Lloyds Bank, they talked in their latest results about continuing to want to buy houses. So Lloyds have been pretty frustrated over the last few years that they haven't been able to find enough homes for mortgage debt, probably because of the regulation that came in post GFC that made it very hard for new buyers, first-time buyers, to get on the housing ladder, because it's difficult to get a deposit and difficult to get a mortgage big enough to buy a house. So, you know, Lloyds got frustrated, started setting up and using their own capital to buy houses and to become a landlord. And in their last results, they doubled down on that. That's something they're keen to do. But it's also pretty clear from the left-hand chart, if you look at the spread of buy-to-let mortgages over government gilts, which is kind of the base money, the funding cost of those mortgages, you can see that actually the spreads are really pretty tight. And I think it's a good indication that commercial banks want to lend money. Another good indication is if you look at their profitability, they are building up capital and they need to put that capital to work. Every quarter, they clip up 10, 20, 30 billion of profits every half year. Sorry, not quarter. They clip up these more profits. They end up in some dividend payments, but mostly end up in their capital, shareholders' capital, and they need to put money to work. And you can see this is very different banking system from post-GFC, when banks weren't making money. They were struggling to recover. They're now making plenty of money, but they need to put it to work. So what we really need in here is a cocktail of low interest rates. The banks are there on standby, ready to lend money. There is pent-up demand. There are, if you look at the equation of rental costs as a share of income relative to mortgage costs as share of income for first-time buyers, we've had that crossover whereby rental incomes become more expensive. So there's a big incentive for them to try and buy a house. It makes their life cheaper. So yes, it's tough scraping the deposit together. Yes, it's tough getting a mortgage at the moment. But with banks having a desire to lend money, and with, I think, interest rates going to be coming down over the next 12, 18 months in the UK, then we'll see the banks starting to put money to work, pent-up demand starting to get fulfilled, and we'll start to see a pickup in housing transactions and a re-acceleration of UK housing. So, I would say the housing market today supports the idea the economy is having a sort of mild recession, or maybe scraping by with a soft landing. We had the PMIs in the UK today, which weren't good either. Neither were they good in the Eurozone. All of that consistent with an economy that's really under pressure. But I would argue that if you look at inflation, and we've done a lot of work on inflation, it's going to come down very fast in the UK as it is across the rest of the world. I don't believe the wage price spiral characterization is a correct one that Andrew Bailey's put out there. He's of the view that that's underway. I don't think that's correct. I think money's pretty tight, and inflation is going to come off fast, so rates will come off reasonably fast, allow commercial banks to push the mortgage debt out the door. So in the next 6 months, we'll start coming through this phase of housing slowing, and we'll move into what I call the winner's curse. And if you look at the 18-year land cycle, I would argue we're about 12 years into the up phase, and we're about to enter what's called the last 1 to 3 year phase, which is the speculative phase of the 14-year upswing of the 18-year land cycle. It's the phase of what's called the winner's curse. In other words, everyone piles in because it seems there's a lot of speculation in land prices, really, which is what house prices basically are. And that drives house prices themselves much higher. And it becomes the talk of the town. It becomes the talk of the dinner party, just as it was in 2005 through to 2007. So the 18-year land cycle works terrifically well throughout the UK's history. It works even better in the United States. It's a cycle in land prices. You can think of it as house prices. As I said, most of the value of a house is the land. And it's a cycle in land prices which includes 4 down years, followed by 14 up years, with the last 2 or 3 years of that being what they call the winner's curse as house prices accelerate to the upside. So ton of pent-up demand, commercial banks in good shape, interest rates coming off is the perfect condition to set up that winner's curse phase for the last 1 to 3 years upcycle in perhaps 2024, 2025, and maybe into 2026, whereby everyone gets a little bit carried away and prices do really quite well. And the economy does well. And of course, the consumer tends to boom during the winner's curse phase. And a booming consumer is good for the UK stock market. It's also good for the UK currency because the interest rates eventually start adjusting and the growth is attractive to overseas money. And it pushes the currency and the stock market higher. And it's consistent with our theme that you're going to see rotation out of US assets into non-US equities over the course of the next few years as people rotate out of growth into value. So I think the winner's curse phase is coming. Housing is going to have a few good years once we get through the rest of 2023, get through the very near-term challenges, because there's going to be a ton of mortgage supplied to this market. And in fact, if you look underneath the surface, there it is, a piece of evidence supporting that idea that really housing is all about speculation in land. Of course it is if you create a ton of money. Over the course of the last just shy 30 years, the value of land in the UK has gone up 8.5 times. The value of housing's gone up 3 times. Completely different quantum. So that's it from us in terms of the presentation. We've written a ton of stuff about housing over the years. This is just a smattering of recent stuff. Very happy to send you any of these that you're interested in. Just email info@Longview Economics or email Nick at Longview Economics. Nick, you see on the screen now. We'd love to hear from you. Happy to share. And look, if you want to hear more from us, we do global asset allocation, global macro. Come to the website. If you're a professional investor, send us an email, as I said, Nick or info@Longview, or visit Substack. If you're into Substack, we put our Friday piece out on Substack. We also got a free week ahead on Substack if you want to think about what's important for the week, how the state of markets. We have a little paragraph or two on that key chart we put out on Substack every week, or follow us on YouTube, LinkedIn, Twitter, etc. So, Nick, over to you. Hopefully we've got some questions. I'd love to hear them. Curious to know what people think.
Great, thanks, Chris. As I said, if you use the Q&A button, you can ask your question. First question, any thoughts on land value tax that would smash housing NPV pretty quickly?
Yeah, I think there's a reasonably good argument for that, actually. I think that's a good idea. That's a good policy proposal. I know the Swiss do that. They have a wealth tax, a percentage of the housing value every year. It's progressive as well in the sense that, the wealthier pay more. Those that rent don't pay anything. So I think there's a lot to be said for it. I really think the wealth inequality as a result of this housing market primarily is a massive issue in this country. And it would be nice if we had politicians that thought seriously about addressing it. And I think that's a very good idea.
Okay, thank you. Any other questions? We'll give it a minute. Yeah, here we go. How does the potential end of the 30-year government bond bull market affect your view that mortgages the banks want will be taken up?
Well, I think there's something in that. I think that makes it harder. I think that's a fair point. I think the government bond bull market probably is done. That would be our view. We like Kondratiev waves. It doesn't preclude housing upswings. You certainly get them over time. You just got to readjust if you go back to that mortgage cost of mortgage share of GDP chart that we showed at the start, you just got to adjust to the new interest rate level. It may take a little bit of time to digest. And bond yield upswings and interest rate upswings, I think the 70s is unusual. The norm is, if you look at the bond market cycle into 20s and 30s, the upswing, you get up to 3, 4, 5%. You're not getting up to double-digit percentages. So that was abnormal, the 70s. That was to do with a lot of money creation, pushing interest rates to abnormally high levels. So, it doesn't preclude the 14-year land cycle. It makes it a bit tougher. It probably makes one disinclined to be a big bull on housing over 30 years, for sure. It's not going to be as good as it was the last 30 years, but it doesn't preclude the problems we have in terms of money creation, the way this financial system works, and the inequality that's created as a result of the high house prices.
Okay, thank you. And here's $1 million question. Is it a good time to buy a house now in the next 6 months, since house prices tend to fall as interest rates are rising?
Well, there's a million aspects to that. I mean, if you don't own a house, it's probably always worth owning one because you don't want to pay rent. But if you're buying it purely as an investment, and you want to flip it in the next 2 or 3 years because you want to play the winner's curse, then yes, I think it would be a good time to buy. Of course, you've got to take into account all the costs of buying and selling, which would eat into your capital appreciation, and of course tax, if it's not your main home, would eat into capital appreciation as well. So you got to think about it in that context and relative to equities and other attractive assets. But yes, I think they'll do well over 2 or 3 years. I would say though that if you want to buy a cheap asset, buy UK equities, much cheaper, unlike housing, which is, I think it'll go up for 2 or 3 years, but it's not cheap. So if you want to play a relative valuation pair within the UK, I would favour equities over housing as a better way to play an upswing in housing, because an upswing in housing will deliver consumer strength and good earnings returns for the stock market in the UK, alongside the commodity super cycle that we think is coming as well, or underway actually. So yeah, probably a good time, but big caveat there if you're buying it to live in it.
Okay, thank you. Loss of a job tends to make paying a mortgage more difficult. So where are you on unemployment expectations cyclically?
Well, look, I think it is ticking up a bit. If you look at the unemployment rate in the UK, the sort of actual unemployment's sort of nip and tuck. It's not dramatic. I think it'll go up a bit more. I don't think it'll go up dramatically. I think this is a bit more like the sort of 2000 to 2002 phase, where the UK just skirted a recession. Unemployment went up a tad. So it wasn't a big issue for the housing market. In fact, if you think about the cash flow behavior of UK households, I think things are looking better 12, 18, 24 months out. It's a very different environment from the GFC, when we had very dramatic increase in unemployment and real issues associated with housing and banking. Banks are in good shape. I don't think we're going to have massive unemployment issues. And this really is not the GFC at all. So yeah, fair point. A little bit of a rise in unemployment rate, call it a percentage point from here, maybe 1.5 even, but nothing like what we saw in the GFC, where unemployment, I forget exactly where it got to, but high single digits, maybe a bit above that. So yeah, not too worried about that for housing in this instance. And let's not forget, by the way, as well, on top of that, if you take all the households in the UK, there's a ton of renters, a lot more than there was 10, 20, 30 years ago. And there's about, I think, 12 million households that own their house outright. So the unemployment issue is less of a concern. They are full-on owners. They don't have a mortgage. In fact, the number of mortgage holders, which I think is also around 12 million from memory, something like that, is the lowest it's been in a long time. So again, reinforcing the idea the unemployment rate picking up isn't such a serious issue as it would have been in the past.
Okay, thank you. How does a higher than expected and later than expected versus market expectations 1 to 2 years ago peak of Bank of England base rate affect the duration of the 18-year cycle?
How does it affect it? Well, it may well be the pandemic's extended the cycle in total length for a couple of years. And I guess the Bank of England's higher peak than expected is really a response to the pandemic, when they printed too much money and stimulated the economy too much. So add those two phases together, the pandemic and this Bank of England rate rising phase, and I think they've elongated that 18-year land cycle. So that previously, the last peak in UK house prices or land prices was sort of, housing was 06, but land was sort of 04, 05. And therefore you wind forward 18 years, you would have been looking at, 2022 to 2024 as the peak, and it looks to me like the next peak might be 25, 26, that kind of idea. So it kind of, I think it elongates the whole thing. It's a good question. It's clearly a genuinely exogenous event, the pandemic, left of field out of nowhere, and slightly changes the timing on the cycle, a bit like World War II did, in a sense, a bit like World War II. So that's what I think it's done.
Great. Okay, thank you. No more questions. So I think we'll wrap it up there. We did publish a note on this about 2 or 3 weeks ago. So if you want that report, please just drop us an email. We'll get in touch and distribute the slides. And if you want the recording, that will be available from tomorrow. So many thanks for joining us. Thanks, Chris, and speak to you all soon.
Thanks all. Appreciate it. Thanks for everyone's time. Thanks, Nick.